Welcome to part 9 of the video series. This one is all about PE ratios. What kind of PE ratios do I look for? What do I look for in a PE ratio? All those kinds of things, guys. So first off, what is a PE ratio? How do you calculate a PE ratio? A PE ratio stands for a price to earnings ratio, basically. What is the price of the stock versus what's coming in for the earnings, and what is that ratio? So if a stock is trading at, let's say, $100 a share, and this company makes, let's say, $10 a share of profit. So their EPS, the EPS for the company is $10. Then you're going to take that $100, divide it by the $10, and you're basically going to get a PE ratio of 10, which would be a very low PE ratio. Most companies right now in the current market we're trading at are trading at PE ratios somewhere around, low 20s, like 21, 22, 23. So 10 would be super low. Now, that's how you calculate it. Why is that even important? Because it basically tells you if the company made this amount of profit, how many years would it take for you to basically earn your full investment back at the end of the day? So companies that have a much higher PE ratio, then they're generally overvalued unless they have huge amounts of growth. And companies that have lower PE ratios are generally more undervalued. Once again, unless the business is totally shrinking, then they're not so undervalued at the end of the day. Now, how does all this, why does a company have a 30 PE ratio versus a 20? It all comes down to perception. What are investors willing to pay for that company? Me, I'm trying to find undervalued companies. So I'm trying to find ones that are undervalued on a PE ratio basis based upon their growth, where I expect the business to go over the next few years versus where it is right now. So sometimes there are going to be PE ratios that are way out of whack. Some of these companies have no PE ratios because they're literally not making a profit. So they don't even have a PE ratio. Some of them traded in, the 400s for a PE ratio. That's super overvalued. Once again, unless they're, expected to get massively more profitable over the next few years. So there's 3 different kind of PE ratios. First is a current PE ratio. That is basically taking what they made for EPS last year versus what the share price is currently. So what they made for EPS last year versus what the share price is currently, that's the current PE ratio, okay? Then there's a TTM, that's a trailing 12-month PE ratio. That's basically what they made for the last 4 quarters in EPS versus what the current stock price is. And then the last one is the forward PE. This is the one I like to look at more than anything. And this is what the company is expected to make for EPS next year, this upcoming year, what the company is expected to make for EPS versus what the current share price is. So I like to look at current PE ratio. I like to look at the trailing 12-month PE ratio. It's definitely helpful to me, but I really care about the forward PE ratio more than anything, because that tells me, I'm making this investment now. What they made last year really doesn't matter to me that much. It matters just to look at, right? But at the same time, what matters more than anything is what the company's going to make next year, because my investment is next year and the year after and the year after. So I'm really looking at a forward PE ratio more than anything. Now, with the forward PE ratio, that is not guaranteed. That's something you got to keep in mind. Just because they have a forward PE of 12, it doesn't necessarily mean they're going to make all that EPS they're expected to make. And also, they could do a lot better than that. So I'm trying to find situations where I think the company's actually going to make a lot more money than what analysts are expecting, or what the company's even expecting. Because maybe you got to understand, a lot of companies in the stock market, a lot of these executive teams and whatnot, they like to lowball numbers sometimes, so they can save some face in case they mess up or in case things aren't as good as they expected or something like that. So generally, a lot of companies that are smart, they'll under-promise and over-deliver. So I'm trying to find those type of situations, ones that I'm like, they're going to make more than that in profits, based upon, this is happening with the business or this is happening. They're going to be more profitable than that. Now, why do I look at PE ratio more than, let's say, price to sales ratio or something like that? Because price to sales ratio is kind of judging the stock price versus what's coming in for revenue, and a lot of people like to look at that one. I like to look at PE more because I care about the profits at the end of the day. I care about what the actual earnings are. The earnings are what matters to me as a shareholder more than anything, because that's the money that can either get paid out to me as dividends, or they can acquire other companies with that money, or buy back more shares and the company can become more and more valuable. Better balance sheet they can use that money for, and that's what matters to me at the end of the day. So PE ratios, I absolutely look for more than anything. But I'm not just thinking about forward PE ratios. I'm also thinking about, what the PE ratio is even a few years down the line. Now, there's also one other factor I like to account for when I'm looking at a PE ratio. I have what's called a Jeremy PE ratio, right? So this is a totally different kind of PE ratio than than you've probably ever heard in your life, if you've ever even know about this, or if you're watching, this is your first time learning about the stock market. This is a total different thing that I do versus a lot of other people. So remember we talked about balance sheet earlier. Remember I talked about the ratio of cash and versus debts and all that kind of stuff. So what I like to figure out is I like to figure out the exact number. So all those numbers are in the balance sheet, right? So let's say, the company has, $10 in cash in investments versus they have $2 in debts. Now, obviously, big companies, they're going to have way bigger numbers than that. I'm just trying to use simple math so we understand this. So that's an $8 difference, right? So I like to take that $8 and basically subtract it from the market cap, okay guys? I subtract it from the market cap, this $8. So let's say the company has a market cap of let's say $18. Their market cap's $18. Obviously, once again, the big public companies you're gonna be investing in have market caps of probably billions of dollars or hundreds of millions of dollars, guys, but we're just using simple numbers, simple math, okay? So this company has a market cap of $18, okay? They had $8 more in cash and investments than versus debts. So then I like to subtract the $8 from that $18 market cap. And now we get $10. And that's what I feel is the true market cap. Now we can take that true market cap and divide it by whatever the earnings were. So let's say the earnings per share last year were $1. Okay, so $1, we got $1 in earnings per share. We got $10 market cap, Jeremy's market cap I like to call it. Now we can divide those and we get a PE ratio of 10 versus if you just calculated it before, it would have been a PE ratio of 18. Now, why did I do that? Why did I even feel like calculating that way? Why do I have that Jeremy PE ratio, I like to call it? The reason I do that is because that gives true value to the balance sheet. That gives something more to the balance sheet for value than just making me sleep well at night, or if I have a recession or something. You gotta understand that cash on the balance sheet, that can be used to acquire other companies. That can make the company a lot more profitable. It's no different. It's no different than I tell you, I'm going to sell you my house. I'm going to sell you my house. I'm going to sell you for $100,000, okay? I'm going to sell you this house for $100,000. You might say, okay, that's a decent deal, but I don't know if I want to buy it. I think I'll pass. What if I told you that $100,000 house has $50,000 buried under the ground? Then all of a sudden you're like, whoa, that's a freaking good deal. That's a really good deal. That's what we're talking about with the balance sheet, because that balance sheet money is generally forgotten. It's never given a value really, but all that money, it accounts for something. So, and it's the same thing if the company has way more debts technically than they do cash and whatnot. I'll add that to the market cap. So the company actually will have a worse PE ratio than would be usually calculated. I like to do that, guys, because I like to give value to the balance sheet. All that money on that balance sheet, it means something at the end of the day. And this is a way of truly giving value to the balance sheet. So I hope you understand fully the Jeremy PE ratio and why I do that, guys, because absolutely that money on the balance sheet, it absolutely does mean something. They can do a lot of things with that money. They can pay it out to you as a dividend. They can use that money on the balance sheet to buy shares back. They can acquire companies. They can do so much. And then forward PE is the biggest thing I look for in a company. What are they expected to make next year? And then thinking about what about the following year? What are they expected to make that following year? And that a lot of times comes down to me being a businessman, making a business decision on seeing the market trends and listening to conference calls and understanding where the management's focus is over the next few years and how that will affect the business at the end of the day, guys. So that is what I'm looking for in PE ratios. I hope you fully understand what a PE ratio is, the importance of it, why I value it so much, and also I hope you understand the Jeremy PE ratio, guys. So I hope you enjoyed that. This next chapter is going to be very interesting. This next video series, it's basically me judging my perfect stock. How would I judge a perfect stock? What is the perfect stock to me, guys? So we're going to discuss that in this next video series. I hope you absolutely enjoy it.